Hi, I'm Rich Steinberg, president of Steinberg Global Asset Management, and with me today is Jacques Elmaleh, my director of research and one of our portfolio managers, specifically in our growth models and in our dividend portfolio. We thought it'd be a good idea today to essentially give you a seat at our investment committee meeting. So we'll have a little discussion of what's going on towards the end of the year and specifically in the third quarter. And why don't we start it off, Jacques? Give us an update of what's going on in the economy.
The economy we expect to continue to grow moderately with employment improving and a shrinking budget deficit.
And how does the employment improving affect Fed policy?
Well, the Fed has linked their policy to improving economy, and as that improves, they will reduce their quantitative easing and move towards a less accommodative policy.
Sure, and as we've talked to you about before, about the Fed's buying about $85 billion with a B worth of securities per month. And over time, if the economy does improve and unemployment comes down from 7.6% closer to their 6.5% target, then you could see some tapering or a cutting back of that. And that has a lot of implications for bond investors and earnings for companies. So why don't we talk a little bit about how the third quarter is going to shape up in earnings and the market?
Well, earnings season is about to kick off for the second quarter, and so far we've already seen elevated levels of negative pre-announcements and reduced guidance. So we could see not so good earnings for the second quarter. For the third quarter and for the second half of the year, earnings expectations are for an acceleration in earnings growth. So if it doesn't materialize, we could have some disappointments.
So for us, we've had some increase in cash levels, but there's another important component that we haven't touched on, which is as interest rates go up, the dollar has gotten stronger. And that strong dollar has implications, doesn't it, for U.S. companies with business overseas?
Yes, absolutely. The U.S. dollar index has gone up about over 5% year to date. And so many of the larger companies that are global conglomerates have significant exposure to the dollar, so that the foreign exchange will likely hurt their guidance going forward for the second half.
Right, we're still maintaining $110 in earnings estimates for this year. It's too early to look at 2014 earnings. So on $110 in earnings, at a recent decent multiple, we could be at 1650 to 1700 on the S&P. We're getting close to that target, then we'll have to reevaluate it. Anything else we should really be thinking about going into the beginning of this third quarter that we haven't touched on?
Well, right now I think that a 10-year Treasury should probably moderate around 2.5% with risk to upside on the yield as the economy improves. In our fixed income strategies, we've maintained a defensive posture with a short-term duration.
As an investor, as you watch the news, you're going to see a lot of two-sided talk from the Federal Reserve, where investors are going to be reacting to very strong news and very weak economic news, or when the bond market gets ahead of itself with rates going up too high of the Fed talking things back down. That's going to cause some volatility. We have to live with it, but we want rates to go higher over time if we have a short duration so that we can lock in higher rates, especially for the clients that live on their income. It's been great spending time with you today, and we look forward to speaking to you soon.
Thanks.